Speaking of the U.S. dollar, let's bring in Mark McCormick, Global Head of FX Strategy with TD Securities. Mark, thanks so much for kicking things off with us today. We really appreciate it. So what do you make of the Fed's decision to move and the message we're getting from them?
The message is clearly very dovish. There's obviously a focus on financial stability, banking sector relative to the economy. And you could classify that as two R-stars, competing R-stars. So what we realize is the financial stability in the banking sector R-star is more important right now than inflation. And I think a big part of it is that the impact of the credit cycle and the tightening and the impact on banks, while it's very unclear how long it lasts, it's actually disinflationary. It creates economic weaknesses. So the Fed is basically buying themselves some optionality. They're moving to the sidelines and say, hey, if inflation goes up, we'll hike by another 25 basis points or 50. But the end game here is basically they're very close to finishing, and the next move is probably cutting rates at some point either this year or early next year.
Yeah, it kind of seemed like Powell was saying that it was taking some of the pressure off the Fed almost with the banking sector uncertainty because it could lead to tightening of credit availability for Americans and whatnot. So that could be sort of making their job easier, although it's clearly made it very difficult as well at the same time.
Right. It creates uncertainty about what's kind of lurking underneath the banking sector, but it clearly gives them an out. It gives them a pivot. And the way you can think about it is through financial conditions. The credit markets are a part of that. Most conventional financial conditions models, this is equivalent to at least 50 basis points worth of tightening. So you kind of got some of the stuff that they were talking about when people were focused on a 6% terminal rate 3 weeks ago. But so that's already come through, and now it gives them the leeway and the optionality to say, hey, we're going to move to the sidelines, and guess what? We're still data dependent. Yeah. So being data dependent means you have a large margin of forecasting error on the things that are coming through. But if there's like hot inflation coming through for the next 3 months, then they will hike further. But essentially, again, this basically ends the terminal rate cycle, at least the way the market's trading it. And this is extremely bearish for the U.S. dollar.
Well, yeah. So tell us a little bit about what's been happening with the U.S. dollar lately, because we did see it sort of gaining momentum this year when the Fed was saying rates have to go higher and they're going to stay there for some time. Right. And then all of the stuff happened with the banking sector, and you can see it sort of come off that higher level at the beginning of this month. So what has been happening?
I think there's two important components. There's the Fed component and there's the global component that doesn't relate to the U.S. And we've been bearish on the dollar because you have this desynchronized cycle where we don't really see this very often, but China's coming out of like 2.5, 3 years of lockdown. There is growth acceleration that comes into China that is coming at a time that the U.S. yield curve was inverted. And essentially the Fed was potentially have to hike into a recession. That's, again, thinking through the terminal rate. So there were guardrails against the slowing U.S. economy, which was Europe, which was China, which is, again, the outperformance of equities outside the U.S., which was weighing on the dollar to begin with. The Fed could have basically changed that narrative by having to hike rates to 6% and being more hawkish, which is where we were a couple weeks ago. But now the banking crisis has kind of taken the Fed out. It's introduced billions of U.S. dollar liquidity. It's not quantitative easing because they're not buying bonds, but there's new liquidity introduced into the market that global investors don't need. So this is dollar liquidity that's being supplied into a market that is unneeded, and now there's an extra supply of dollars. And this is again, it's bullish for the emerging market carry trade. It's bullish for the euro. It's bullish for the yen. And again, it's probably bullish for most risk assets relative to U.S. assets. And
when you're talking about that liquidity, you're talking about the central banks expanding the swap lines over the weekend, that in particular, or more as well?
Yeah, and the facilities and the winding down. Like, they're not winding down quantitative tightening because, again, they're not buying bonds, but they're lending out dollars into the market, which, again, if you looked at the credit markets or the OIS or the international kind of swap indicators, they're not telling us that there's banking stress in Korea or in Europe or, there is a little bit in Switzerland, but that was ring-fenced. Yeah. But this is not a global banking shock right now. So this is treated as a shock that changes the trajectory of U.S. monetary policy. And again, you still have the rest of the world outperforming the U.S. economy right now. And this actually accentuates it, depending on how much growth can be taken off the U.S. economy in the next 2 to 3 quarters.
Let's touch on the Bank of Canada as well, because it released its summary of deliberations, just the second time that it's done this. It did that this afternoon. And within that, it said that they didn't even debate increasing rates at the March meeting, because we did get a pause earlier this month from the Bank of Canada. What did you make of what, that, or, what you saw in those deliberations so far?
Well, I think it's interesting. You could kind of compare it to the U.S., right? So this is kind of conversations we're fielding. The Canadian debt banking issue is more related to the knockoff effects of housing. We see this in our models that the Canadian dollar has become inversely correlated with one of our rates and stress factor, which is like not how the FX market or how people think it works, which is rates go up, currency goes up. What you're actually seeing is for certain countries, Canada, Norway, Sweden, Australia, New Zealand, countries that have vulnerabilities around their housing market, as interest rates are going up, these currencies are selling off because you're pricing in a weaker growth outlook. So I think what you're seeing here is that the banking stress in the U.S. is kind of taken over. That relates to growth. And the fact that there's lower inflation, or at least a downside surprise in inflation, and along with the Bank of Canada moving to the sidelines and even sounding a little bit more dovish, that's actually good for the Canadian dollar because you don't get further rate hikes that can potentially create economic downside risk for the Canadian economy. So it's kind of counterintuitive, but the minutes and the conversation and them moving to the sidelines is actually good for the currency now that stuff has shifted to the U.S. side.
I want to make one more stop with the U.K. because today we got that inflation report of the U.K. We're going to talk about it a little bit more later, but we did see inflation there accelerate in February. So what does that mean for the Bank of England? And should we be concerned about just the fact that it is accelerating when most central banks right now want to be seeing that coming down?
Right. There's a lot of volatility in the month-to-month data. I think one of the things that's important is that wages was a bit contained. So, obviously, even like with the U.S. inflation number, it was generally kind of hot, but it's mixed in terms of the generalization of inflation, like kind of how much of the different baskets of inflation are moving in the right direction. So what we're seeing in Europe is there is more inflation in Europe, particularly on the ECB side, where they're going to have to continue to hike rates. From the Bank of England, basically what you'll get from a messaging is tomorrow is they're probably going to have to hike one more time, but they're moving the sidelines. Because this is the one country where you kind of have proper stagflation, where growth is really moving in the wrong direction and inflation's moving in the wrong direction. And it's just an environment that's not great for policymakers, but they are probably going to go with the expectations that global inflation is moving in the right direction and that over time inflation will kind of moderate. But you might get one extra hike that markets weren't expecting coming through on that inflation number.
Okay. Well.